Hello guys, this is Vinny Chopra again, weekly podcast of the Apartment Syndication Made Easy. As you recall, I wrote that book last year, which became top seller in the nation, internationally also. And then my new book just came out last week, and I hope you have picked up that also. I'm so fortunate to have a great friend of mine today, Melissa Marcolini Quinn, right? Did I pronounce that right?
Yes. I know. That's why I always tell you, just say Melissa Quinn. It's easier. So many people get tripped up on the Italian. So.
No, I'm so glad to have you, Melissa. And, we are thinking the title could be like Trend in Multifamily Financing that you need to be aware of. And Melissa is one great professional, guys. I'm going to tell you my personal stories and all the good things that Melissa has done and her team has done for me and my partners in Florida, in Texas, all over the place. So you are in for a great treat. So get your pens and pencils out if you're in the car listening to us, or you're in the YouTube, you're watching us, go ahead and take some great notes. I want to introduce you, Melissa, formally. Melissa has been actively involved in the commercial real estate industry since 1996. 1996. That
makes me sound old.
25 years. 25
years.
You
sound old.
He joined the Orlando office of NorthMarq Capital. We'll talk about that in 2004, and has become one of the company's top real estate investment bankers, specializing in the origination of debt, joint venture, equity, and structured finance. And Melissa holds the BA degree in finance from the University of Central Florida. She's repeatedly part of the NorthMarq's $1 Million Club, and is a top agency loan producer within the company. Let's welcome Melissa to the show today. Melissa, I'm so glad you took the time, and maybe your, right person, Rob, might join us also, during the conversation. But please tell me a little bit more, where you grew up and how you got into the loan, lending industry, I guess is the word.
Well, Vinny, thank you so much for having me on. I really appreciate it. And as you said, we've done a lot of business with each other, known each other the past couple few years, and definitely have a lot of respect. So, and congratulations on your new book.
Thank you.
Which is fantastic, right? So, just a little bit about my background. I grew up in New York, but I've been living in Florida. We say long enough to where, the New Yorkers don't consider me a New Yorker anymore, but not long enough to where the Floridians will ever accept me as a true Floridian. So, but I've been down here for a long time. And so I started in commercial real estate, actually in the property management side of the equation. And then, went back and got my degree in finance. And then from there, went and started working in the financing industry of commercial real estate. So I've been with NorthMarq Capital, as you said, since 2004. I started actually as an analyst there, and then quickly went to senior analyst, and then went into production. And so right around the time, I think, right before the downturn, but it was just, you kind of weather that storm, and you can get through pretty much anything. So, but I actually started in affordable housing. That's where I got my first start in terms of, being in production. And so went through all of, understanding tax credits, LIHTC 4%, 9% tax credits, all of that fun stuff. Did a lot of HUD loans. A lot of Freddie and Fannie, et cetera. And then if you know affordable housing, you can do conventional market rate housing like the back of your hand. If you know market rate, you can't necessarily do affordable. So that learning curve is just sometimes too much. So needless to say, I started doing a lot of conventional multifamily, and multifamily is what I specialize in. It's not, I also do, hotels. And when I say multifamily, it's from the gamut of all the way from affordable through to senior housing, right? So, but, I also do hotels, but usually, and it's weird because I have some clients that have a large portfolio of multifamily, but also have a portfolio of hotels. And that's usually how that comes to be. and I actually say if you understand hotels or if you understand senior
Oh my
housing.
gosh. No, definitely. Actually, we bought one in Texas, my other partners, Hilton Garden Inn. I'm happy to say it's 100% occupied, even
Wow.
during COVID. So
Wow.
we are fortunate. We bought
That
it.
is incredibly impressive because I can tell you a lot of my clients that have hotels are not in that same boat right now at all. But I know we didn't come to talk about hotels. We came to talk about multifamily, right? So we can do a whole nother podcast about hotels. But in the multifamily world, it's definitely been interesting. Last year was a fantastic year. I was top 5 for Freddie Mac producer in my company, top 10 for the company overall production. So, and just churning and burning, right? I mean, we a lot of business, a lot of volume, and that, as I said, multifamily was hot. Yes. In the beginning of the year, I mean, I was lined up by the end of the first quarter to have my ducks in a row to basically do by the mid-year what I did in all of last year. So, but then COVID hit. And all of a sudden, everything came to a screeching halt. Now, it definitely picked it back up because, of course, interest rates dropped dramatically. So it became a good time to refinance deals that you may have already financed before, even if you had a prepayment penalty associated with it. The acquisitions kind of came to a screeching halt for a little while. A couple months in to COVID, I think those acquisitions are really picking up, and we've seen it. I've seen it. I think in the beginning, the acquisitions were having a little bit of a meeting of the minds difficulty where sellers and buyers weren't quite at that equilibrium, right? And I think a lot of buyers thought there was going to be upwards of a 10% discount due to COVID. And what we ultimately found is that discount was negligible.
Oh, wow.
To be honest. I mean, I think what we're really seeing across the board, and we do have a NorthMarq investment sales platform as well. So, and what we really are seeing is more like a 3% discount type of thing. I think people are seeing that, COVID is not, in some markets, it's definitely bad, right? Where it's affected the assets. But in most of the markets, I mean, people are weathering the storm. At the end of the day, people have to live somewhere. That's what I always say. I mean, they have to live somewhere. And so, yes, there's been moratoriums on evictions, and that's hard and challenging to navigate as a landlord, right? And as a result, we're monitoring it as a lender and with all of, our borrowers in that portfolio. But the reality is what I've seen is that the landlords that work with their tenants and kind of say, hey, if you're having trouble, we'll set up a payment plan, something to that effect. They're seeing much less in terms of a delinquency. Now, again, it's still going on. And the jobs report wasn't as what we would hoped today, right? So, I think that this is a very dynamic situation, right? It's fluid. We just got to, kind of see how it rolls out. But I'm actually more pleasantly surprised that it wasn't the sky falling type of, scenario that I think we all thought it was when it was first coming down the pike in March and April. I think that was kind of a terrifying time, frankly, for everybody.
A lot of people actually predicted it to be much worse. I agree with you,
Yeah.
And also the forbearance. Forbearance, not forgiveness.
Yeah, forbearance. I mean, and I had a lot of, and I understand the reasoning for it, but I saw a lot of emails coming out from a lot of competitors saying forbearance. And I was kind of telling everybody, put the brakes on. This is not something that you want to exercise unless you absolutely have to exercise it. Okay. They can say it's not going to go against you. On the Fannie Mae side, it definitely, the DUS lender is going to take that into account, whether or not you needed to execute forbearance and how you behaved in it. But even on the Freddie Mac side, I mean, while they're saying it's not necessarily going to be held against you, it's still going to be taken into account. We have to do an REO analysis, right? So we have to do a whole analysis every time we submit a new deal to Freddie or Fannie on your entire portfolio. And if you have multiple deals that have been in forbearance, I mean, that's something that is going to factor into whether or not they're going to do a new loan.
Right.
So, because it goes into the health of your overall portfolio.
Correct.
So that's why it's, one of those things where I was trying to be an advisor during that time and say, just think seriously. If you need it and you're desperate and you definitely need this to prop up, yeah, do it. I mean, because we'd rather do that than take the keys back, right? But if you think that you can eke by, and it came with a whole bunch of strings attached, by the way, in terms of what you were able to could you evict? How long did you have to wait? You had to get the lender uphold before you can start evicting people. All of those things it came with. So it wasn't something that I think people should have entered into, without a great deal of thought. And we did have some that made some inquiries and then said, not going to do it. So the vast majority of borrowers did not actually enter into forbearance. And so I think that also has helped to prop up the market, right? Because I think, if Freddie and Fannie had been flooded with forbearance requests, it would be a factor as to what they were going to be doing in terms of lending on new product. So, it all plays off of each other. So, and as a result of there not being this giant flood of requests, I mean, there was requests, don't get me wrong, but it wasn't the tsunami that everybody predicted it to be. And so, we've had flow of capital like crazy. And as I say, there's a lot of dry powder out there.
Yeah.
There's a lot of money sitting on the sidelines waiting to be deployed. And Freddie and Fannie both are very aggressive. HUD is also, but you don't generally use HUD for an acquisition because it takes too long to process, right? But HUD's been a great avenue, especially in the construction side of the equation, because banks are having some difficulty. Stop me if I'm talking too much, but
no.
Banks are definitely having some difficulties because of COVID. The regulators came in and turned around and said, okay, we have to reevaluate your entire portfolio. And what people have to understand is that doesn't necessarily mean multifamily. Banks do a lot of lending across the board, across commercial real estate. And if they had a big exposure to hotels or to retail, which we know is getting beat up, and office is even, out there getting a little beat up as well, as people are not, occupying, they're still paying, generally speaking. The delinquencies haven't gone through the roof, but, the forecast for office is not as high as, it used to be, because they're starting to think, well, maybe a lot of people are going to work from home, and how long is COVID going to last for? I'm still working from home, right? So, I mean, this is occurring, so maybe we don't need as much space as we thought that we were going to need. So all of these things factor in when they're evaluating the overall health of portfolio of banks. And they definitely hit their pro formas in a big way. So you saw a lot of true balance sheet bank lending start getting a lot tighter. Any of the things that are considered high risk, which is construction, is a lot tighter, a lot more difficult to get. And when that happens, just like it did in the downturn, HUD becomes a great alternative to construct multifamily, because you can do a 221D4 at super cheap rates. It's, interest only first 2 years, followed by 40-year amortization. It's automatically converting. It's a non-recourse loan. All the way through. And so if you can navigate the process, it's definitely attractive for a lot of people. So
the HUD loans, I know I've heard that it takes longer.
It does, a lot longer.
Application process, the whole determination. Is it like maybe 90 days or 120 days or 6 months? Hi there, Rob. How are you, bud?
Rob is my right-hand person. He is my partner in crime, as we say.
Good to have you, Rob. I'm so happy you can also join. And, we just kind of in the midst of talking about HUD loan right now. So timing-wise, Melissa, you were saying?
So timing, it depends. One, if you're going for a 221D4, which is new construction, right? Or if you're going for a 223F, which is a refinance of an existing structure, or if you're doing an A7, okay, which is a refinance of an existing HUD loan, okay? So from timing starts, it ratchets down, right? For a 221D4, honestly, people will throw out, hey, I can get it done in this period of time. And I kind of say, all right, you want to be safe on it, give yourself a year on a 221 deal and close on that deal. Okay.
Wow.
Especially if you're in certain offices. So for a deal, say in Florida, if you're reporting to Jacksonville, they have a history of being pretty slow. If you're reporting to the Atlanta hub, then they're a lot faster, right? So you could probably get that done in 9 months versus 12, but it's still a long period of time for a new construction to get done. And there is investment that you have to actually make into it. You have to have your full plans and specs done. And so, before you even know if you have a loan. Now, there are some ways of mitigating that a little bit, because we do have to go in for a concept meeting initially, right? And then, it is a 2-step process that we go through, and I'm more than happy to provide like details on that. If you want, I can give you a whole little spreadsheet. But at the end of the day, there is money. There's market studies that you have to, get, and there are things that we have to pull together before we can even submit for a concept meeting. So when it comes to a 223F, that, again, it depends on the office that you're talking about. I've had them take 6 months to get done, but generally speaking, you want to allot for 4. That's why you use it for an acquisition, because you're just not going to be able to get it done in that period of time. They're not fast. It's a process that you go through. And as I explained to people, understand HUD's not a lender. HUD's an insurance agency, really. It's a government insurance agency. So that's why you have the mortgage insurance premium. That is covering, guaranteeing that loan with the full faith and credit of the United States, right? So ultimately speaking, NorthMarq, we're the lender, and we're selling it off to the actual back-end buyer after closing, okay? And so that's how the HUD lenders work, but it's insured through HUD. Okay, so that's where, it can, but it's super cheap. You're talking about, interest rates in the low 2s. And the great thing is that, you have a, if it's a 223F, or refinance of a deal, that's a 35-year amortization. And so you have a 35-year amortization. It's open to prepay after 10 years at par. Okay. Generally, it's locked out for 2 years, followed by 8, 7, 6, 5, 4, 3, 2, 1. So you have a declining prepayment penalty.
Yes.
And it is assumable. The only drawback is that there are no supplementals, so you can't lever it up when it comes to HUD.
Like in Fannie Freddie, we could, right?
Do assumption, and then we can go back and try and do an A7 and try and increase it. At least it's complicated because you can't go above the original balance, but there's ways you can add in a lot of costs and so on and so forth. And that's a rabbit hole that we may not want to go down right now. But generally speaking, that's the drawback. Whereas Freddie and Fannie are both assumable, and you can get a supplemental associated with it.
And the supplemental can be from the person who is the originator, and they can one more supplement when the buyer is buying. Is that right? We could do twice.
Yes, yeah. So exactly. So now Freddie Mac, you can go back to the well, right? Fannie Mae, you can. Technically we have to get a waiver, but it hasn't been a problem for a second and third supplemental if you need it. It's just technically speaking, you have to get a waiver, right? So yes, say you buy a property, and a year later, you've done some value creation. They don't generally like to do supplementals if it's strictly cap rate compression. Okay, they do like to see some sort of real value created. But you went, you implemented a CapEx program with it, and you did some renovations, etc. And so now you want to go back to the well and you want to take some money out. You can do that. You can absolutely do that. It has to be after 12 months. Okay. You can't do it the first 12 months, but after that, you can absolutely go back to the well and do it. There's always a little premium on the interest rate for the supplemental portion. Your senior will always stay the same, but for the supplemental portion, there's always going to be a little premium on that. But blended with your senior, it really doesn't matter. So it's in the noise kind of thing. So the minimum is $1 million. They don't want to look at anything on a supplemental that's underneath that. And generally speaking, when they're really busy, they're going to tell you it's got to be at least sized to 2 million. Okay. And then, but say you did that, and then 3 years later, you went and sold it at some big profit. That buyer can now come in and also do a supplemental. They can lever it up. They're assuming your supplemental, your original senior, and then they'd be getting a new one.
So free loans then on the property.
But they all are coterminous with each other. So and so they'll have the same maturity associated with it. It's tacked on to the loan docs, you know. So it's basically an allonge that's done to the loan docs. So, but all of these things make it very, very attractive, right? Because even in CMBS, you can assume a CMBS, but you don't lever it up.
Yes.
So it's one of those things that Freddie and Fannie bring to the table that I think not a lot of others do, right?
For sure. I would love if you could kind of give a little bit intro of Rob, how he joined you, and he's your right-hand person, and just a wonderful person when we met together there in Orlando. Yeah.
I hired Rob actually, and I don't know, I usually like it. What does it feel like now, 20 years ago? So it's like, what, 11 years ago? Well,
yeah, I remember because that's when the financial crisis hit.
Oh, okay.
Exactly. Great time. So, but yeah, so I hired Rob right out of the University of Central Florida, my alma mater. So I certainly have, you know, a school pride sense of affection for that. And he was definitely the best candidate. And so Rob and I don't even know how we've worked on over $1 billion together. And I couldn't do it without him. So nobody who's listening to this is allowed to try and steal him. I'll hunt you down. But no, I mean, I couldn't do it without him. He's definitely the brains behind the operation.
Oh, I love it. I love it. You know, if we could kind of, let's go back as what are the minimum loan size do you guys get involved in? And what's the highest loan you've given so far? Or, you know, aspirations for,
Highest loan. Highest single loan I've done was the highest single loan that was in a portfolio was 77 million.
77 million. Wow. Which is about 70-30 split. Then property has to be, you know, up in the 100.
Yeah. And then we did an assumption and supplementals on that. That was done with Fannie Mae. And so, and that one, I think it ended up selling for 120 million down in South Florida.
Oh, wow.
So,
yes.
You know, people can actually look at it. It's the Quay at Palm Beach Gardens and such. So, and then, but that's on the refinance side. So then, I mean, God, I'm trying to think because, I mean, I also arranged JV equity for, you know, clients and have done that on construction, and preferred equity as well, and construction loans. So, and sometimes it's all like blended. I mean, last year I did $115 million portfolio, but it was a mixture of new Freddie Mac loans, existing Fannie Mae loans that we were assuming, and in addition, and actually including the Fannie Mae loans, was more like 223 million. So, but, and then I also did arrange $40 million of equity. For that transactions across 11 properties. And that one was interesting. We from start to finish, and I think I damn near killed Rob. We were working 24/7, but the equity fell out from this borrower at the last minute. And so I had to bring one of my institutional investors, and we did it in 9 days from start to finish on a large portfolio of 11 properties. And so that was not something, I mean, it was a great transaction. It felt great when it was done, but I don't know if I want to go through that process again and doing that in that short span of time. So
Totally, totally. You know,
The smallest deal, I think, the smallest deal I can really do, frankly, is it's got to be above $2 million. It's very difficult to get done. Now, with Freddie Mac, you really have to go to the small balance side, and we do work with a small balance lender. It doesn't cost the borrower anymore, but we do have a strategic relationship with a small balance lender, an SBL lender. It's just not something I target on a regular basis. For the most part, I'm in the $10 million and up sweet spot, and like to be around that 20 million. So it just all depends though. But I mean, for repeat clients, I mean, we'll actually, for one of our, good friends, Enzo, I did a small loan over on the East Coast that they were buying that was nearby property they were nearby an existing deal that I had done for them. And so it just made sense because it was just right around the corner. And that was Villas at Atlantica. And I think that was, what was that, 2.1 from? Something like that? Yeah, 2.1 million. So.
I know you gave us really good, in the Orlando, the Bentley loan, you guys did the 41 million, I think.
Yes, it was 41 million.
Yeah, that was amazing. And, going back at it, I just was going to ask you, I was thinking about it last night. We had to go through a lot of easements or something. Can you kind of shed light on that? Yeah.
Yeah, so that was an interesting deal because of how the property was configured. And so, I mean, I've been doing this a long time, right? So I know one of the things that Rob and I always dig into in the beginning is the property. And even if we don't have a survey, we'll go on the tax assessor's website, all of that, just to try and make sure that there's direct access to a public right-of-way. Right? Because that becomes a problem when there's not direct access to a public right-of-way and there's a large adder. It can be upwards of up to 10 basis points if that doesn't occur. I've had that happen where I've had to fight that fight. So at that end, I took a look at Bentley, and Bentley was an interesting configuration because it happened to be built within an overall PUD that had some condos associated with it. This was an intact, complete apartment complex, but in the PUD itself, there were other parcels that were condo developed and were sold as condos. So this one, the road, I don't know how much in the weeds you want me to go.
Yeah, a little bit. And some of the audience might be saying, Vinny, what are you talking about?
Yeah, like, what is she talking about, right? So, we owned the beginning of the road, then it went into the homeowners association, owned a portion, and then it went back to the apartment complex, and then it went to a condo complex. So, we had to go through like tons of different iterations, and the survey had it overreaching the property lines at some of the roads, but then we had to have that redone, and we're able to fix it and go through a whole series of mitigants to the lender as to why they shouldn't be concerned about this. And digging back in original docs in the clerk of courts, that's what Rob and I sat there and did, went through in the clerk of courts like tons of documents on how the original parcel was sold off back when it was an old farmer owned it, and how it was developed and how it was carved up, and et cetera, et cetera, et cetera, and the easements associated and who the easements were in favor of. And so it wasn't fun, but that's part of why we get paid, right? I mean, same thing with any type of, not unusual for us to find where there will be permits, for instance, that haven't been closed out.
Yes.
That's not unusual, especially in an apartment complex. If you have a large apartment complex, you'll see it. You have tenants that have a grease fire, for instance, or something like that. The small fire it's put out doesn't do massive amounts of damage, but you have to get permits to clear it, right? And to do all the work and have it inspected, et cetera. And if that's not cleared out, that becomes a cloud, right, on the lien. And then we got to try it. So poor Rob, he's been an expert at like trying to navigate all the clerk of courts and getting on. I mean, I think was it on Bentley, Rob, that you actually went down to the physical location of the clerk of courts to get that all cleared out?
Oh, wow.
Yeah, that's your hands dirty and just meet with the person and figure it out.
Yep.
Right?
I love it. I love it. I mean,
And
that's
which
something.
saves the borrower a lot of money because usually their attorneys will start taking care of that.
Oh,
And you pay attorney by the hour. You just pay me a fee when it closes. So I
no,
always say
no,
that.
I definitely want to say, definitely, to have a great loan broker team like you are. I mean, how smoothly you made it for us, my partners, and I really respect that because I think the biggest thing I find in syndication business, of course, the investors are bringing equity money, but the loan, I mean, the lending institution has to close on time and make sure that the funding comes from both sides to consummate the deal. And I'm so happy that I've had 29 or 30 syndications I've done so far. And it's always been because of the great, broker,
Yeah.
loan broker like
Thank you
are.
for that.
Yeah, no, really, it's so, so true. Let me ask you a question like, if we were to say a lot of my audience are getting into their first deal
Yes.
or fourth or fifth deal, what kind of pitfalls, would you say that some of the things they can avoid, as they are looking into a multifamily, maybe $4 million worth or $7 million worth like that?
Yeah, yeah. Well, one, make sure that you're balanced. You're going to have to sign a carve-out guarantee, right? And you have to have a minimum net worth and liquidity in order to be able to qualify. So try and vet that out first. If they're first getting into the game, honestly, what they want to do is partner with an experienced syndicator, become a GP on the overall, and you're going to have to pay some dues, right? Because the fees are really going to go for the experienced one. You know what I mean? You may find a great deal, but really the one who's bringing the experience and that net worth and liquidity to be able to sign on those carve-outs, et cetera, is the one that's going to be making the majority of the money when it comes time to closing it, right? But you got to pay those dues so that you can actually say that you've actually done an agency deal before. I mean, it's all part of the game, if you will, right? You want to be in the org chart. You're going to have to bring some skin to the game on that, but that's a matter of getting that done so that you can actually demonstrate that experience. That's what we've done multiple times with syndicators, right? And so the pitfalls that you want to look for is making sure that you kind of know what you're talking about and that you partner with the right person who can help guide you on this. It is a process. You also want to use a lender that is experienced. I'm just going to be honest with you. You don't want to use what I call a junior jet ranger, okay? Where they can talk a great game, but can they actually execute it? And I will say that I've worked with a lot of syndicators before, and part of it is guiding them home from start to finish. I'm going to turn this over to Rob real quick, just because.
Oh, okay, sure, Rob. Yeah, please go ahead. Yeah.
Right. Yeah. So, I mean, it's basically, you want to trust who's providing your loan, right? And, like she was saying, people will talk a good game and show a lot of fancy marketing materials, but, you need someone with experience. Just for example, like the easement issue or the net worth issue and navigating pitfalls like that. And believe me, there's not just those two, there's hundreds of potential. I mean, not to scare but the minefield of issues that how lenders can be. So that's what we're experienced in navigating.
Yeah, I'm back. Sorry about that.
No.
But no, I mean, and like to echo what Rob was saying, one of the things that you actually do want to look for when you're looking for a lender is somebody who's going to hold your hand throughout the process. And also shield you from some of the bad stuff. We do every single transaction that we work on. There are always pitfalls. As Rob said, there's hundreds of them. It's a matter of don't alert the borrower unless you have to.
Yes.
If you can actually figure it all out, get it done, get it, glossed over and everything's fine, then why do they need to have the stress? Right? I mean, like they have enough to do with raising money and trying to put this forth and everything. That's what we're supposed to be there and get paid for. And so when it comes time to strategizing as to solutions, sometimes you come up with that. I mean, I've had a deal where a partner was brought in and lo and behold, we found out that he had a personal bankruptcy.
Oh, yeah.
That's a problem. And it was not too long ago personal bankruptcy. And so it's kind of like, hey, listen, I don't care what you do in terms of a side letter or whatever, but you can't be in the org chart. You know what I mean? So it's just trying to figure that out so that you can mitigate it all and still get that deal done. Because ultimately, it's all about getting the deal done. And getting it done as you promised you would at the terms that you promised you would, right?
So true. And how about felony also, right? So same thing, personal bankruptcy, felony, that also is a big one.
Without a doubt. Without a doubt. I mean, I will say I've had a deal where there was a client that, had illegally shot a big game, you know what I mean? And it was like a wanton waste. What was that called again, Rob? It was like a wanton waste of a large animal or something. And believe it or not, in Alaska, that's a felony. So there are certain things that, generally a lender can, okay, I get it, maybe have a little pricing adder, because pricing goes a long way, okay? So have a little pricing adder and we can get past. If it's something that deals with malfeasance or, any type of fraud, especially, or, misappropriation or something like that, where embezzlement or anything, you're not going to get too many. I mean, that's a high octane lender then, as I call it. That's the hard money lender. That, if there's like, some Ponzi scheme or something like that, you're not going to be lendable amongst the institutional side of the equation. So, but it's something you vet out in the very beginning, right? We try and just at least do a LexisNexis report in the very beginning on everybody so that we know who our client is. We don't have the same kind of levels that a lot of banks do because we're not a formal bank.
Correct.
Okay. So we're an investment banking firm, but we're privately held.
Oh, you are privately held. So there are assets that you do fund then, right? You take.
We're not funding anything on our balance sheet, right? But we're owned by the Pohlad family out of Minneapolis, Minnesota. They are a high net worth family. They own the Minnesota Twins. They own lots of car dealerships. They own a large production company. They've done some Hollywood Academy Award winning movies. So I mean, we're well capitalized, which is great because we have NorthMarq actually has a $65 billion servicing portfolio. So we service
You're one of the largest ones.
We have a huge servicing portfolio.
Yeah, huge. I was thinking about like some other people, maybe Greystone, but they are lower, right? Lower.
There's, I don't know where they are now. I mean, I remember that they were at one point around like the $20 million or something, but a billion. I mean, but I'm sure because they've been pretty prolific in the Freddie and Fannie world as well, that they probably ratcheted up that servicing platform.
Totally. So. Can we take us to this? I see there's a lot of powder, right? You mentioned that dry money on the sideline, and also stacks. So can you kind of, in a layman terms, kind of explain how it can happen to buy a multifamily where the investor's money comes in, then a capital stack comes in, and how it all works out in the end, I guess,
Yeah. And so you have your senior loan, right? And that senior loan, you're going to max out around a 75, maybe 80, but not in COVID world right now, but 75% LTV.
Yeah.
Depending on where interest rates are, sometimes we're actually debt cover constrained. Okay. And so we're not actually even able to get up to that 75%, or depending if you're buying a value add, we have to underwrite to existing income in place. You're buying it because you know that you can increase that income, right? But we're going to be held to that. So on a debt cover basis, you may actually be debt cover constrained at that 125 or 130, depending on where the market is, right? And so if you're at that level, then it may, and it only works out to be a 65% loan, say, it might actually make sense to layer in a preferred equity piece. We can bring in JV equity, but preferred equity is just like on top. You're not diluting your other investors in terms of their upside potential, right? Because it's all about what you're paying your investors out in addition to when you sell the asset, what their return expectations are. And so if you're splitting that with a JV equity provider, then you might run into some difficulties anyway when it comes to your investors, your syndicated investors that are coming in where they have an expectation of getting the majority of that return, right? So, but whereas a preferred equity player coming in is basically kind of like a mezz, right? It's almost like a loan. You get a coupon, a minimum multiple that they want to see, and then they're out.
Yeah.
And so that's generally speaking, as soon as they meet those metrics. Now, some of them want to be in there the whole time. It just depends, but they're not getting part of the upside gain when it's
right.
Okay.
As the limited partners, like
Right.
say Class A, B, C, the limited investors, they are for the cash flow and the upside gain. But the
Right.
capital stack, it could be a fund, a life insurance company, or
Yeah.
who are these people who do the capital stack?
It all depends. I mean, there's institutional investors, right? So, you have many funds, as you mentioned, who are putting it together. REITs are also, in that world, and very heavily in that world of providing, preferred equity capital there. But, it's not a given, right? I mean, it's one of those things that when I have a client that is entertaining, filling in and throwing in a slice of PE, they'll come to me, and then I shop it to all of my different, avenues. And sometimes they'll be like, you know what, that deal's too frothy. We're not interested, or it just doesn't work out, or I'm not crazy about the market, or et cetera, right? Or I can come in for 4 to 5 million or something like that. You know what I mean? It just all depends. Or we can get a whole bunch of no's and get one yes. So, and that's all you really need, right? Is that one yes.
Yeah.
There is an adder when it comes to the pricing adder for the senior loan. And generally speaking, on the Fannie Mae side, they don't really like preferred equity at all. So it has to be structured in a way that I always say kind of completely emasculates the PE provider, the capital provider. So it's just something that you really want to navigate around, and you want to use somebody experienced who understands how to navigate through that. You don't also want to go to, I mean, I have a lot of JV equity investors. I have, a lot of preferred equity investors, but not everybody. I would not be taking them on a Freddie or Fannie loan, unless then you don't want to generally be using them. You don't want to be the guinea pig on your deal.
So true, because it does come with, I'm sure they want to be more involved in the deal. You have to more transparency.
You do. You need to know that too, is that, when you're a syndicator, right, and you're the GP, you're controlling your deal.
Yeah.
You're reporting to your investors, of course, you're doing all of your fiduciary duty to your investors, but generally you're running your deal.
Yeah.
With a preferred equity piece, understand they're providing that extra, like, way up the capital stack. So they're going to want to have oversight to make sure that their equity investment is protected. There are certain rights that you have to give away in order to bring that in. So it's just be aware. It's one of those things. If you need it, explore it. But if you're going agency, only do a deal with somebody who has gone behind an agency loan before. You don't want to do a new one. If you don't need it, you're most of the time better off just using syndicated equity. You really are.
Surely.
So,
my gosh, you're giving so many great nuggets, Melissa and Rob. I really, really appreciate. Boy, we could spend more time. It's almost 54 minutes or 50 minutes.
Oh wow, I didn't even realize. Oh look,
I know. We've had so much fun. But I want to thank you, both of you, and thank you for taking the time to be on my show, and really appreciate. How can people reach you? And please tell us.
Well, I mean, I'm at NorthMarq. My email address is mquinn, so M as in Melissa, Quinn, at NorthMarq. That's NorthMarq Okay, so we like to make it nice and difficult for people.
Yeah.
.com. And so, I can tell you my cell phone is 407-222-7132. Shoot me an email, shoot me a text. I'm more than happy to talk to you and, help guide you. And, we do have a team. I have another colleague of mine that I work very, very closely with on a lot of different deals.
Right.
So, we have depth.
I would definitely say to my audiences, guys, please remember, at least 2 million loan, right? 2 to 3 million, and preferably 5 or 10, million. So I really respect, your time and everything. And, thanks again for coming. I really enjoyed having you, and, God bless you. And thank you again for the deal. Closing now in Austin. We're going to be buying 4 or 5 more deals.
That's a great deal. That is a fantastic deal. You guys kind of really found a diamond in the rough, frankly. So it's not that easy to find those under market rents that you're able to push. And yeah, that was a good find.
Oh, thank you. Thank you so much. And again, thank you for taking the time. And I would like my team kind of tells me a little bit about here. Hey guys, everybody, if you like what you heard today's show, episode and benefits of loaning real estate into loans, we dug a lot more into it. Reach out to us. And our line is always open to see if we can help you achieve your goals. Please visit vinneychopra.com for more information. And if you like to invest with us, visit vinneychopra.com/invest. Also, I've done my Multifamily Academy, where I teach also every week if you'd like to know more about it. But don't forget to like, subscribe, and comment, and share this episode. If you found value, and if you think someone that can also find value in it. So thank you so much for joining.
And one more thing I will say to your audience that, when I said find an experienced multifamily owner operator, I would encourage them actually to reach out to you, Vinny. I'm more than happy to work with you on any financings that you endeavors that you want to pursue. But that's kind of what I'm talking about when I say find that experienced player out there that you can go ahead and invest, alongside, and that can guide through that process, because we've done Freddie Mac, we've done Fannie Mae, like we can get it all done together, and at least I know I can get it across the finish line for you.
Appreciate that, Melissa. No, I really believe, we met, I was mentioning, I got to know you for 2-3 years now. Yes. I love it, and who you are, and we met out there in Orlando, and we met with the families and all. And, such a great feeling to have somebody who can hold you and take you to the closing point. And that's what is so important. I always say that, I can bring money from the investors, unless the lending is not there, it cannot work,
Right.
So you are a very big part, both of you are.
Thank you. Well, we're good partners.
That's the way. That's the real way. Thank you so much. Bless you, and you have a great day. Bye-bye.
You as well, Vinny. Thank you. Take care.
Very well.
Thank you so much.
Bye.
Bye-bye. Bye-bye.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to vinneychopra.com. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.